Hey guys, it's Stan here. Today we're going to talk about a super important topic that is broader than just finance. You know, usually on this channel I produce market finance and corporate finance content. Today it's much broader because we're going to talk about the downside of low interest rates for myself, for yourself, for all of us. So why is it so important? Well, you probably heard since the beginning of the pandemic that all the central banks have decreased the interest rates. So what does it mean? First, we will look at it. Why are interests so low and what does it mean? Second of all, what is the downside for me? Because the upside is pretty simple. If you have a loan already, a car loan or a student loan or something like that, the interest rate is going down, so that's a positive aspect for you. The thing is, there are a lot of downsides to it that you should definitely know. It has a lot to do with investment. At the end of the video, I will also to give you a few tips and tricks. What can you do against these pretty big downsides and what do I do personally? So let's get started, guys. The first thing which is very important to understand is why do we have low interest rates at the moment? That's not only important if you work in finance, but that's important to understand because it's like the fundamentals of economics, and you should take this 1 minute maybe to really understand what's going on. Pretty simple to understand, you will see. First of all, well, you all know that here in 2020 we are all in a big crisis. This time it's a pandemic, but in 2008, for example, it was a financial crisis. But at the start of low interest rates, you always have some kind of big crisis. What is happening when you have a crisis? Well, the central bank of each country, for example, the Federal Reserve in the US or the European Central Bank in Europe, all the big central banks, one of the first reactions to crisis is to reduce the interest rates to stimulate the economy. They are also doing a lot of other measures like stimulus packages and these kind of things, but now let's stick only to the interest rates because you will see that it has a huge impact on you and on me as well. Well, when the central bank is reducing the interest rates, it makes borrowing cheaper for companies and also for individuals. Why are they doing it and does it make sense? Well, in theory, and usually it works, when borrowing becomes cheaper, then companies and individuals invest and spend more. Think about it. For example, if a car loan is not 4% but 2% at some point, you as an individual, you will say, oh, maybe I'm going to buy a new car, for example. Just a simple example. And for companies, it's the same. The end goal of all this thing, and that's why the central bank is reducing the interest rates, is that companies and individuals invest and spend more. Why? Because this creates growth, and as we all know, growth is kind of the engine of our capitalistic societies. So growth is super important. Once you have a check on growth, then the question is the growth producing inflation? What is inflation? Inflation means that the general prices, let's say of food for example, is going up in the country. This could be dangerous because if you have a lot of inflation, let's say 5 or 10% or something like that, you have to think about increasing the interest rates again because that's going to be good to reduce the inflation. Let's forget the end part because that's not what we want to discuss today, but now let's focus on low interest rates. Now that we know why we have low interest rates, let's look at what are the downsides to it. The first downside is pretty logical, but I still like to talk about it. If you have lower interest rates, of course, it also applies to your savings accounts, which means lower interests means lower returns on your savings account. Let's imagine if you have savings and usually get maybe 2% or something like that. Well, right now, because of the low interest rates, you will probably get a 0% return. And the problem is, it doesn't stop there because you have an inflation of roughly 1%, which means that if you have your 0% return minus 1% inflation, you have a -1 yearly return on your savings, which is a pretty bad deal, obviously. So if you have $100 saved today, in 1 year there's going to be worth roughly $99. So as you can see, it's a pretty bad investment. That's not really the problem. The problem is what do you do, because here is where the mistakes come. One of the biggest mistakes that come from low interest is that, well, people usually know that they're not gonna get anything on the savings account, so they say, oh, you know what, I'm gonna spend my savings, or even worse, I'm gonna borrow cheap money, because right now obviously the interests are very low. So I'm gonna borrow cheap money, and the problem is they're gonna buy unnecessary stuff. I give you an example. Let's say you wanted to buy a used car, but now that you can because it's cheaper due to the cheap money, I'm gonna buy a new car because the car loans are super cheap. This kind of stuff, really be aware of it, because that's a huge mistake that you're gonna pay probably for the rest of your life, depending on the price of the car, obviously. Another huge mistake that comes from low interest rates is that a lot of people think, oh, hurry up, it's time to buy a house. And first of all, it sounds pretty logical, because you say, okay, if I can buy a house now, it's gonna be great, because obviously if the interests are low, you're gonna pay less interest on your mortgage, so the mortgage will be cheaper. But that's a huge miscalculation, and let me show you why. Understand the real estate problem. Let's take an example. Again, we are starting with our low interest rates, and as we just discussed, low interest rates lead to 0% returns on your savings because the interests are so low. So in this case, any individual, but any big investor, everybody on the financial market, every big player in the game, it doesn't matter if you're a small player or a big player, you will have to find a solution for this year. You get zero returns, so what do? Well, in finance, there is only one solution. For higher returns, you need to invest in riskier assets. What types of riskier assets do we have? Riskier than savings accounts? Well, we have real estate and we have the stock market. Let's take the example only of stocks to keep it simple. The problem with real estate is the following. Let's imagine I have a mortgage here, and my goal is to say, okay, you know what, right now I'm renting, but since the interests are so low, I'm gonna buy the place, because right now the interest rates are super low, so my mortgage will be cheaper because I can borrow cheaper money. That's a big mistake, because look at what happens here usually. The mortgage, you have three things in the mortgage. The house price plays a role, because obviously, let's say if you take a loan over 30 years, you're gonna pay the house price back, obviously. Then you have the interest rate, so the interest you're gonna pay on your mortgage, and you have the insurance. Forget the insurance right now, and let's focus on the two other parts. As we just mentioned, it's interesting theoretically to buy a home or an apartment right now, because money is cheaper, so you can cheaply borrow. So this is great here because the interests are going down. The problem is, you're not the only person who has this great idea of buying and hurrying into a real estate deal right now. Let me explain you what it means. Well, since the demand is going up for real estate, because everybody wants to invest in riskier assets to get returns, well, guess what? The house price is going up. So actually, a lot of people right now make that mistake to rush into the real estate market and to buy a place because they think it's cheaper, but actually it's not, because what you're gaining in cheaper interests, well, you are paying it more with a more expensive house price. This is also what explains that within a pandemic, like a big crisis like in 2020, the house prices are still going up, because all the investors, including you and also the big guys, they want higher returns, and so they need to take bigger risks, such as, for example, real estate investing. So by investing in real estate, be very careful and make a wise decision. If it was, think about, forget the crisis and think about, was it my plan to invest in real estate? If it was the case even before with higher interest rates, then it's probably a good thing. You should buy your place if you want it. But don't buy real estate, don't buy an apartment or a house, don't get into a long-term loan just because you think it's gonna be cheaper right now, because that's a tricky situation. You're gonna win with interest rates, but you're gonna lose because the house price is going up due to higher demand. So keep that in mind, because that's super important. So now that I have talked about real estate, let's quickly talk about the other branch, which is the stock market. So what's going on over there? You probably saw the news that during this year of 2020, which was very rough for the global economies in general, for example, the S&P 500, the biggest 500 companies in the US, well, they have reached an all-time high. So how is it possible? Well, same reason as for the real estate. Think back here. Investors like you and me, but all the big guys as well, they want or they need higher returns, so they need to invest in risky assets such as real estate, but also stocks. So what's going on here right now, basically, all the money that is in the system goes either to real estate or to stocks in general, because that's where you can get higher returns in the long term. But what does it mean for you? Well, if you already invested, for example, for your retirement plan or something like that, and you have already, if you already have stocks, that's pretty good because you're gonna get a good return for this year. But if you're just getting started investing, and if you're, don't make that mistake to rush into something because maybe now is the opportunity. Don't think like that. Because same for the stock market, if it's going crazy up, there's always a factor. With stocks, also be very mindful. If you wanted to invest long term into stocks, that's fine, no problem. But don't try to speculate short term because the stock market is going up right now. You know, you don't know what's going on in the next couple of months. So be very mindful, especially because right now everything seems to be a little bit overvalued because money is cheap, which means that everybody invests in real estate and in the stock market. So be very careful. So now that you know the downsides, I wanted to tell you my tips and tricks. How can you avoid, or how can you profit? How can you make this downside an upside? So how do normal people like you and me, how do we handle this low interest environment? Well, I started with explaining that savings could be a big problem because obviously if you get 0% on your savings, it's kind of bad. But I wanted to mention what am I doing when it comes to savings. Savings, it's really like a balance act because you don't want to have too many savings because, well, you don't get any returns on that. But you want to have some kind of buffer because otherwise you don't know what's going on, especially in a crisis. So what am I doing? For my savings, I have pretty simple logic. I want to save 3 times my monthly expenses. Let's imagine my monthly expenses are $3,000. Well, then I want to have $9,000 of savings. You can easily track your monthly expenses in your online banking and this kind of stuff. So the idea is to have a buffer of roughly 3 months because you never know unemployment, medical bills or whatever. So I would go for 3 months. Everything over it, so if you're easily over it, you can start investing and thinking about other opportunities. But if you are below that, try to get to these 3 times expenses saved. 2 little tricks I use for my savings and how I can save more. First of all, obviously, you need to decrease unnecessary expenses. I have a very simple strategy for that. And I'm not talking about food and all that stuff. I'm talking about, let's say, you want to buy a new pair of sneakers at Amazon. I have a very simple strategy that works very fine. It's called leave it in the cart strategy. Very simple. Most of us are online shopping, and what is great about online shopping is you can, if you want to buy something, put it in the cart and leave it there maybe for 3, 4, 5 days. And you will see that after 3, 4, 5 days, well, the kick of buying something actually, well, lowered actually, and that means you don't really want and you don't really need that thing. That's how you can save a ton of money, and that it has worked very well for me. Obviously, if you're running out of toilet paper, just buy it. That's common sense. My second strategy, and I used it actually a few months ago when it was clear that public transport in New York was bad, so we needed a used car. So first of all, obviously, don't buy a new car because of depreciation. It's gonna be it's gonna ruin you long term. It's a pretty bad idea. So what did I do? Well, I did a lot of Googling and stuff like that because my goal was to buy a reliable used car. And I found out after long research that Toyota obviously makes the most reliable, best used cars. A little tip here, a car channel that I found, Scotty Kilmer, Google this guy. You can also ask him questions. So if you have absolutely no clue about cars like myself, Ask this guy, ask you, let's say you have $3,000 or $5,000 to invest in your car. Make sure to ask this guy, he's gonna answer you. He has like a 3 million followers or something on YouTube and all the social platforms. So make sure to ask this guy if you need car questions. He's gonna be very helpful. Now we are at the point where you have more than 3 times your monthly expenses saved. Well done. And now the question is, what do you do with the surplus? Well, investing in long term, that's the strategy. You don't want to speculate and you don't want to spend it on unnecessary stuff you don't need. What's the difference between speculate and invest? Well, speculate, you are looking for a very short term return by taking a lot of risk. For example, let's say Bitcoins are at 10,000 and you invest everything you have in Bitcoins, and in 1 month you want to cash out and you want to gain here. 2 problems with speculating. First of all, it's super risky because you are putting all your eggs in one basket. You don't want to do that, obviously. And second of all, there is a big tax problem with speculating because obviously the government doesn't want you to speculate because it's bad in general for the economy. Why is it so bad tax-wise? Because imagine you are buying Bitcoins at 10,000 and a month later it went up to 15,000 and you are selling it, so you made a gain of $5,000. Well, guess what? There's gonna be a massive tax on you because it's a capital gain tax, which is about 40% in the US. So obviously from not only you took a huge risk to invest in that kind of stuff short term, but also you get punished by the tax authorities. So that's why speculating is a very bad idea with your savings. So now, how do I invest long term? Pretty simple. Let's find out. For my stock portfolio, for example, I use the very simple and very recognized buy and hold strategy. Warren Buffett, for example, talks about it a lot. Very simple. You want to invest in a diverse index fund. Index fund, you can Google it. They are very low cost and they are very diversified because you can, for example, invest in the S&P 500, which are the 500 biggest US companies which are listed on the stock exchange. So diversified because you have a lot of different sectors inside and you have very big profitable companies. Second point, which is also very important, that I mentioned earlier, you have to invest long term. Don't think about next year or in 2 years or something like that, but think about 20 or 30 years in advance, depending on your age, obviously. Because on this kind of horizon, historically, you get between 6 and 8% returns. So that makes a lot of sense, especially in low interest rates periods where you get 0 on your savings. So 6 to 8% long term is a great investment. Also, what is also very important, and I mentioned it when I was talking about the speculation and the tax impact, when you do such a thing, use tax-efficient retirement accounts. For example, in the United States, you have the Roth IRAs and 401ks. In other parts of the world, you have similar retirement accounts. So just Google it for your country and see what is the most tax-efficient, because you don't want to pay a lot of taxes on your gains, obviously. And the last point about stocks and how I do it, I invest the same amount consistently. For example, let's say you have $500 that you can invest every month. Just set up a monthly transfer and forget about it. You know it's gonna be invested, you know where it's gonna be invested, and in 20-30 years you're gonna have a very nice return due to compound interests. Very simple stock strategy. Now let's move on to my real estate plan. So when it comes to real estate, you gotta be really careful, because don't forget, it's not like you are investing in the stock market, for example, where you can decide I'm gonna put $200 each month inside, but you are committing long term because you are using a loan usually to buy the place. So the first and important recommendation I have for you: don't buy real estate because the interests are low. This is what I mentioned at the beginning of the video, because you are getting into a long-term debt commitment. So the real question is, do I really want this apartment, or is it just, am I just buying it because the interests are low? That's very important. And also very important, if you can't afford what you want, let's say you want this kind of apartment or this type of house for this kind of price, if it's too expensive, go smaller. That's very important. In the US, for example, so many people have too much debt because they bought their place is too big. So that's very important. How did I mention, how did I do it when I was 25, for example? Obviously, I couldn't afford a $500 flat or something like that. So what did I do? Well, I started very small actually. I bought a student home apartment I knew in a city in France. So actually I bought it $85,000 and I knew it would be rented out for about $400. So and if you calculate the profitability actually is $400 times 12 gives you $4,800 a year of income, and 4,800 divided by 85,000, which was the purchase price, gives you roughly a 5% return when it's rented out the entire year. So this is how you can beat low interest periods, for example. And for real estate, really go small first and be very careful. That's my tip. Now that we have talked about everything I had to tell you, I wanted to tell you that I post once a week every Sunday. So if you like corporate finance, if you like market finance, make sure to subscribe. Also make sure to like this video. It takes me about 7 hours to do it. So don't forget to smash that like button. See you soon, guys. Enjoy your week. Bye bye.